Good morning, everybody. Paul here coming at you with a Crypto Coffee update, a segment where we talk about all of the news, events, and happenings that are coming out of the crypto and blockchain space, helping you to make sense of the rapid development that we're seeing in the new world of digital finance. And if you will, join me for the namesake of this series for a simultaneous sip of fresh hot coffee. Good stuff. All right, so let's go ahead and dive into the happenings of the day. Simon Chandler wrote a fantastic article at Cointelegraph talking about how the SEC's guidelines and statements show that it's slowly learning to accept and understand ICOs. He does a fantastic job outlining some of the current guidelines and distills them down into 5 major points, and they are as follows. ICOs can be securities offerings, letting people know that, hey, these indeed can be classified as securities, and of course, with that said, they may need to register as securities with the SEC. If you recall, a number of projects, including Aragon and Gladius tokens, they had to refund all of their ICO money to investors and essentially start again from square one, registering as securities if they wished to proceed with their token sale. So it can be a bit unclear, but also something to consider if you wish to start a ICO for your project. Tokens sold in ICOs may be called many things. Looking at you, securities tokens, ICOs may pose substantial risks. That should go without saying, but for some individuals, the rose-colored glasses of meteoric rise in price can help to blind them from this. And ask questions before investing. Always ask questions. We say here at Cryptide, do your own research. It is absolutely critical to DYOR, do your own research, and ask critical leading questions about ultimately what you may or may not be investing in. Of course, there's the Howey test, which we've accessed before, but just for the sake of it, we will go ahead and open up. Oh, this is the Wikipedia article, not the actual website. It shows a fake ICO website. There's no know your customer or anti-money laundering steps on the actual token sale, but ultimately it's an SEC project to help users get familiar with what some fraudulent projects may ultimately look like. And this is interesting. I found this comment from Jay Clayton, the SEC chairman, peculiar. He said, the fraudsters flock to the new and attractive space. I guess that shouldn't surprise me, but it does. As one of the largest and most powerful regulators in the space, I found it kind of interesting that the chairman of the SEC didn't expect fraudulent activity to flood into a new unregulated space. Seems to be natural ultimately, especially given the ease with which you can facilitate financial transactions using this new technology. However, things are slowly but surely starting to open up over time. More details are coming out and potentially more clear ways forward that can help this space ultimately grow. Now, I wanted to start out with this piece for a particular reason. I went over to ICO Bench to help to highlight exactly why the SEC's guidance and regulations eventually that they may author about the space are so relevant. So let's go ahead and take a look at icobench.com/stats. You can head here too if you wish to get all kinds of really interesting token metrics. And you can see top countries for ICOs, USA leading by a large margin at 733. Countries raised in terms of funds, USA 7.4 billion. British Virgin Islands, which is generally seen as kind of a tax haven, 2.4 billion, and so on. So you can see that the United States leads by a large margin. Here's the amount of ICOs by count. You can see the United States with a much darker shade than any other country on the map. And by funds raised, it gets even more disparate in terms of the lead the United States has. So ultimately, the SEC's guidance will be very relevant for the token space going forward. Now, if you want to start an ICO in the United States, if that's something you may be considering, of course, none of this is financial advice. Here's a fantastic article from Mitchell Moose out of Crypto Slate. I love this outlet. Fantastic article by him talking about some of the regulations that came out in 2015 that can help you to decide how you may want to move forward with your own project. And this can happen in really any ecosystem, whether you're launching on Ethereum, whether you're launching on Corda, which is R3's platform. Ultimately, if you're going to tokenize your ecosystem and have a public sale, this is something that you will assumingly want to consider and consult with your legal counsel. Again, none of this is financial advice. So why is this so relevant? Because 48% of ongoing ICOs lack what's called MVP, or minimal viable product, despite the bear market. That's also another metric that is tracked here. Minimal viable product, MVP. You can see 53% have, 47% do not. So over here, they kind of rounded up a little bit, demonstrating that most of these tokens actually don't have anything to present to their users. So you may have invested in these projects and they sounded great on paper, but when it comes to the actionable steps taken to ultimately result in deliverables for the investors, something that is seemingly should go without saying in terms of fiduciary responsibility. Ultimately, that hasn't happened in almost half of all projects. So that's not to say that all of these projects that have not resulted in definitive deliverables are scams. That's not the case at all. Many of them were just poorly thought out, or perhaps ultimately ran into snags along the way. But nonetheless, these are very startling metrics to see. And hopefully will be something that will begin to ease up in terms of projects being able to see their use case through to a finished minimum viable product with a bit of help from the SEC's guidance and maybe a bit more consideration as to how they may want to configure their project before launch. Now, some of these coins were indeed scams. One coin, which was a coin that promised very similar to BitConnect, something we referenced in a previous Crypto Coffee update, they guaranteed a set amount of returns per day on any amount of money invested. This is the classic Ponzi scheme, pyramid scheme model, something a lot of multi-level marketing companies are taking up nowadays as well. And the founder, a gentleman by the name of Ruja, that's his sister actually, where's his name at? Yeah, Konstantin Ignatov. Don't want to butcher his name too bad, but yeah, this gentleman was arrested in LA at the airport as he was trying to fly somewhere. That was a $3.8 billion revenue scheme, so huge amounts of capital were sunk into this, and this both attests to the FOMO, or fear of missing out, that many individuals feel when viewing something that they may perceive as a good investment. Ultimately, it is an emotional state that can cloud critical judgment and ultimately prevent individuals from asking these critical questions before investing, leading to investments in, well, Ponzi schemes and other scams that may or may not be the best individual choice. And when it comes down to pyramid schemes, there's never a good choice that results in somebody joining. So ultimately, we don't have much information in terms of how this is going to unfold. The individuals just arrested, so we'll keep you up to date as things unfold, as news comes out. But basically, prior to his arrest, this guy traveled to the U.S. to meet OneCoin affiliates during a meeting in Las Vegas. He asked when members would be able to cash out their OneCoins. His reported response was, "If you're here to cash out, leave this room because you don't understand what this project is about." So this is the most brutally honest advice OneCoin investors have ever received. So unfortunate stuff. Definitely feel bad for the people who invested, but it ultimately goes back to doing your own research. It's critical. And speaking of federal guidance on these issues, state guidance is also beginning to shape up. Colorado's Digital Token Act provides security exemptions to businesses leveraging utility tokens. So this is something, again, even if you're saying it's a utility token, the SEC has a bit of discrepancies in terms of how this may be viewed, since tokens sold in the ICOs can be called many things. So just because you're calling it a utility token, it doesn't mean that it's not going to be classified as a security. But now we see state government offering a bit more insight and guidance as to how you can potentially avoid a discrepancy in state and federal classification for your project. So this is something to very reasonably consider a reasonable road to consider going down if you wish to launch a token that will ultimately have utility. It's called the Colorado Digital Tokens Act. And to describe the bill, quote, blockchain technology has the potential to create new forms of decentralized Web3 platforms and applications that have advantages over current centralized internet platforms and applications. The Colorado Digital Token Act will enable Colorado businesses that use crypto economic systems, I love that term, crypto economic, to obtain growth capital and help grow and expand their businesses, thereby promoting the formation and growth of local companies and the accompanying job creation, and helping make Colorado a hub for companies that are building new forms of decentralized Web3 platforms and applications. So they want to make Colorado a hub. And this is very interesting given the geographical relevance of Colorado, as it's situated right next to one of the exciting regions in crypto, Wyoming. I know it has Jackson Hole, Yellowstone National Park, lots of wonderful skiing weather and that sort of thing, a bit expensive to vacation to. But one thing's for certain, they released 13 new crypto-friendly laws just recently. Here is Caitlin Long. She is I'll call her a crypto lawyer. I'm not sure if that's a title she would accept or how she would like to call herself, but essentially she is someone who is heavily involved in crypto law. And she has a great podcast with Sasha Hodler, and they go into essentially why these laws are necessary, some of the history of securities laws that I just found fascinating, especially the 1994 securities ruling that ultimately kind of shifted the definitions of securities as owned assets to more of a contractual obligation. And so a lot of great insights into why these laws are configured as they are, why things like Colorado's Digital Token Act are so relevant to the ecosystem, and how the federal government ultimately maybe needs an overhaul or can potentially shift how these securities are viewed to instill a more robust notion of direct ownership. So definitely go check out this podcast episode. It'll be below in the description, along with everything else we talk about here today, since after all, gotta cite your sources, folks. Super, super important. Sharing is caring. Now, Fidelity is also offering a digital asset Bitcoin custody service. It's finally going live for eligible clients. They said it would be in Q1. It looks like they're delivering, so that's great stuff. This is a corporation with over $7.2 trillion in assets under management. So that's very exciting in terms of overall potential exposure to crypto assets now available through the Fidelity platform. But as said, only a few clients, including qualified hedge funds, family offices, pension endowments, etc., institutional investors primarily, as you can see here, are going to have access to this particular platform just for the time being. So over time, it may become operational for a larger group of individuals, but assumingly it's going to stay relegated primarily to institutional investors, which is good, since having a custodial form of ownership of your assets is beneficial since it can shield you from some of the potential bad ends. However, as Caitlin Long so inceptuously delves into, having the de jure direct ownership is very critical since it removes any ambiguity into how these crypto assets are handled from a legal perspective. So we're beginning to see some very interesting developments in terms of federal and state law in relation to how these custodial entities are beginning to enter the crypto space. Not intrinsically related, but very interesting to observe nonetheless. Perhaps you think so too. Now, next up, we have another sovereign nation, Marshall Islands. They rejected the IMF concerns to launch a sovereign digital currency, or SOV. Essentially, they're looking to launch a wholesale central bank digital currency available to the populace and all to utilize as a method of payment. This is something that the IMF has warned against, saying that there's a lot of issues in terms of money laundering that have yet to be worked out. However, Marshall Islands President Hilda Heine says this is a historic moment for our people. Finally issuing and using our own currency alongside the USD is a step in manifesting our national liberty. The Marshall Islands have received a large amount of capital from the United States for kind of using their territory as an atomic bomb testing ground. So it's reasonable for the United States to pay recompense for the environmental degradation wrought on the Marshall Islands in the name of scientific and military progress. However, with those payments coming to a close, it makes reasonable sense that the Marshall Islands are looking for new methods by which to modernize their economy and open up to the new exciting world of digital finance. It is still tenuous and tentative whether or not this SOV, wholesale central bank currency, will be a move that will demonstrate itself as prescient and forward-thinking, or perhaps with reckless abandon running headlong into unproven technology. The IMF certainly thinks so, that it's going to be the latter, and here's a quote to back that up. In the absence of adequate risk mitigation measures, the issuance of a decentralized digital currency as a second legal tender would not only increase macroeconomic and financial integrity risks, but elevate the risk of losing the last US dollar CBR. So there are definitely some risks that the IMF is identifying. However, the Marshall Islands seems to want to move forward regardless. This is a very interesting test of how these smaller nations seek to navigate their comparatively smaller economies in a pond of larger economic fish, such as the United States and, of course, the IMF, which is more of an aggregate body to represent global financial interests. Moving across the Pacific Ocean towards Brazil, hopping over the Andes Mountains, we are now here looking at the fact that a Brazilian court has ordered a bank to return over $330,000 to a cryptocurrency exchange. Banco Santander has been ordered to give back money to a crypto exchange after essentially claiming that its funds were incompatible with bank policies, and so there was a freeze on the funds before anything could get sussed out to see whether these funds were legitimate or not. This individual had 1.3 million reals frozen. That's not so good. And here's a quote from the court ruling. In light of what's exposed, I find it justifiable the formulated requests condemning the defendant to refund this amount of capital fixed by the practical table of the court, plus interest cost of this amount. The defendant will support legal expenses set at this amount of the condemned value. So not only are they getting their capital back, but ultimately they're receiving some recompense for the trouble of having their assets frozen in the first place. And no reports yet as to whether or not this is going to be a larger precedent for Brazil as a whole. However, with a relatively disparate population spread all across the coast and the city of Manaus situated, Manaus, directly in the center of the Brazilian Amazon rainforest, populations such as Brazil could very much disproportionately benefit from distributed ledger tech and greater financial access. So this could be a positive sign in terms of the trajectory for the burgeoning South American economy. Next up, we have a technical article really highlighting Mitchell Moose's work today. The guy writes some great articles, I gotta say. Big fan of his work, always has a sound view of this kind of thing and strives for objectivity, something that you don't often see in the crypto space where clickbait is rampant and things are happening just at lightning speed. Lightning network pun right there for you. But Mitchell Moose always does a great job keeping it level-headed as he writes these articles, and so just wanted to give him a shout out there. Monero upgrade successful. So Monero, as we've discussed in a previous Crypto Coffee video, is a privacy coin. It uses ring signatures, which is a cryptographic means of ensuring what's called plausible deniability. It is not cryptographically secure in terms of zero-knowledge proofs. Ultimately, what it does is it collects all these transactions, mixes them together, and uses cryptography to ensure that it could plausibly be either you or any other peer's wallet that is making this payment. There are some perhaps technical inaccuracies that could be teased out in that very short and succinct explanation, but suffice to say, rather than using zero knowledge, it uses plausible deniability. It's neither intrinsically good nor bad comparing the two, but one thing is for sure about Monero, they seek to ultimately be more of a smaller mining coin rather than having large mining farms. So because of this, they want to fork, using hard fork, move away from these ASICs or application-specific integrated circuits. This is a twofold benefit and kind of a detriment to a degree. Ultimately, it decreases the amount of mining power necessary, it decreases the total amount of mining power on the network. That's what I'm trying to say. So because you no longer have these large, powerful machines working on the network, they are now banned, it ultimately decreases the total amount of energy being put into the network. However, proportionally, i.e. each individual is now putting in a greater share of the network's energy. So it's more distributed and more decentralized. However, there's ultimately a smaller total amount of energy being input to the network. So it was successful. They've done this before. They forked away from the ASICs. Now they have less hashing power. It's more distributed. And as we saw in a previous Crypto Coffee video, this has put a few, at least one vendor out of business simply because they relied on the ASIC mining machines to be able to facilitate some profit. It was what was it? It was essentially the one that allowed you to mine Monero in your browser. So that's not a thing anymore, which could be good, could be bad. I mean, if you were inadvertently doing so at the benefit of somebody else, it's pretty good. So here is the hash rate we were talking about. Over 80% of the hash power is now gone, which is crazy to think about. So 80% of the total energy that was being input into the Monero network is now gone. It's completely just kaput, defunct. So you can see here a chart, and here we have the portion where it just drops off precipitously. And this has been a very large point of contention in the crypto space, whether or not what's called ASICs, again, application-specific integrated circuits, ASICs, these machines that are explicitly built for crypto mining, whether or not they're healthy for the mining ecosystem, or whether or not perhaps they're more of a detriment due to mining centralization. And there's no clear answer. There's no objectively correct answer. It's all about what people view as potentially best for the network. And there's no one size fits all. Ultimately, if these ASICs wanted to make their own network, they could, but they wouldn't take the main developers with them. So there's many questions and variables to consider when considering what is right or wrong for a crypto ecosystem. One consideration as well is this is potentially why some more enterprise-level, quasi-centralized systems serve corporate and business interests more readily than some of these newer, more distributed cryptographic systems, simply because there needs to be a notion of stability in business so that you can project earnings and activities forward to the most reasonable degree possible. It may be why we've seen institutions like Hyperledger and, again, R3's Corda gain more and more traction. Just in the last episode, we talked about how the SIX stock exchange over in Switzerland partnered with R3 to build on their platform. So this just goes to show, while the exciting nature of the ever-changing crypto ecosystem that we see here is exhilarating and amazing to watch unfold, there are definitely some real concerns in terms of enterprise applications that need to be addressed before any enterprises and institutional clients begin building on these more, I guess you could say, I don't want to say wishy-washy, but more volatile systems. Next up, speaking of volatility, WinRAR has had a 14-year bug, an exploit that was allegedly threatening crypto wallets. Essentially, here's how it works. The user says you open the wrong RAR file in an unpatched version, a payload's dropped on your Windows startup file, so when you boot it up, you load the exe, and this could be like a crypto mine or really anything that the individual hacker wants to deploy on your system. And since nobody updates WinRAR ever, and you're supposed to buy a WinRAR license, I know you've all purchased your WinRAR license. It doesn't seem like this is something that has been updated very regularly. Apparently, WinRAR has always been been known for its wide support of all popular compression formats. It's not updated since 2005, and access to source code is not available. The decision was made to drop ACE archive support starting with WinRAR 5.7. Now, after the launch of the final and stable version, upgrading immediately to the new 5.7 version is highly recommended. So it looks as though there's some fix already out there. That's good. Just make sure your WinRAR is up to date to WinRAR 5.7 so that you're not running any outdated versions of the WinRAR software, potentially leaving you open to this exploit. Pronunciation. And another one, MakerDAO votes to raise the Ethereum-backed loan interest rate by 2 percentage points. This is a really interesting project here. I admittedly don't know as much about it as I should, considering you could see the amount of information that I dig through on a daily basis, along with my other work obligations and responsibilities. It can be exhilarating. Like I said, I love it, but there's only so many hours in a day, and I got to get food and all that, so you know how it is. But it is essentially a coin that is pegged 1-to-1 to the US dollar, but instead of using a more centralized system to enforce that, it is what's called a decentralized autonomous organization, or DAO, and how it governs is through a voting mechanism. So this required all users to vote and come to a conclusion as to what may be the best percentage point through which to govern the overall rates. And suffice to say, that is a very difficult thing, and there's a range of interest rates that kind of fluctuates between a particular set range that is voted upon. So it was really encouraging to see a decentralized autonomous organization come to a conclusion that ultimately seems to propel the health of the network forward, rather than kind of confederating into their own camps of ideological interest. So that's really neat to see. So now that rather than being pegged at around 97 cents, the value is now jumped up to right at $1. So it seems all's well that ends well for the time being, and this MakerDAO vote demonstrates the health and resiliency of the decentralized autonomous organization and the ecosystem on which it is built. So you can get more information here at the article, and I'll have some more information on MakerDAO for you here in the coming month or so when I have some time to do a deep dive into it. I hear chatter all about it over on the crypto Twitter and in the ecosystems I inhabit. So definitely about time to do a deep dive on that one. Next up, something that has been confirmed, semi-confirmed, no word on Reddit or Discord, but it seems the Neo blockchain is down. It's been down for about an hour as of 4 hours ago. Okay, sorry about that. Had a bit of technical difficulties, but we're good. All right, so the Neo blockchain has apparently been down for over 1 hour. Again, this is not corroborated as of yet, still a lot of opaqueness occurring, but Neo uses what's called, I believe it's particularly defined as delegated Byzantine fault tolerance. But suffice to say that the vast majority, the supermajority actually, of the Neo blockchain nodes are ran through either the city of Zion or Neo themselves. So if something has went wrong with the Neo architecture and their nodes, then ultimately this would help to explain ultimately what happened. So just some interesting stuff. Like I said, we'll keep you up to date on anything that occurs with this story as we get more formal verification as to that's exactly what happened. But for the time being, we got all the important stuff out of the way, all some exciting stuff about ICO stats and how you can take actionable steps to better define what your project may be and in what jurisdiction you may want to base your project. But as said, not financial advice, just interesting considerations that you can make your own actionable decisions from. Links below in the description, of course, so you can ruminate on this information. But for now, that's all the time we have. Thanks so much for watching, guys. Seriously, if you just hit the little like button and the subscribe, that actually helps the channel a lot, helps it to grow. And also, we have a Discord invite below in the description in case you want to have more one-on-one discussions about this kind of stuff in a community setting, more live discussions, I guess I should say. But for the time being, my name is Paul. all. Thanks so much for watching. We are Cryptide, and remember, the tide is rising, as is hopefully the SEC's guidelines and clarification as to how you can launch your project in America. Good stuff.